The battle lines in India's delivery wars are starting to become clear. With the Q1 FY26 results now out for both Zomato and Swiggy, it is time to ask that do we have finally a winner? To understand this properly, you need to see that this is no longer just a food delivery story. There are three major forces shaping this space, and they go far beyond what's on your plate. However, before we start, make sure that you subscribe to the channel and join our Telegram group where we have more market related discussions. The link is in the description. First, the broader narrative. Quick commerce is eating into the market share of traditional kirana stores. The growth of dark stores and ultra fast delivery models is putting pressure on mom and pop retailers. Now, these stores, which have long formed the backbone of Indian retail, are now at serious risk. Their decline will also impact the ecosystem around them. Everything from small creditors and local lenders to apps like Paytm that build financial products tailored to them. Meanwhile, quick commerce warehouses are sprouting up, and this shift is already visible in the startup landscape. Roll-up brands like Good Glam and Global Bees, which depended on physical and retail integrations, are either bankrupt or in deep stress. Now, these are second-order effects of the quick commerce boom. Second, we have to understand that Zomato and Swiggy are no longer single businesses. They are now two-headed beasts. On one side is a food delivery, which is a mature, cash-burning business that may never be sustainably profitable at scale, and on the other hand is quick commerce, a uniquely Indian opportunity with long-term potential to disrupt kiranas and capture a massive share of everyday consumption. Unlike food delivery, quick commerce can work because of dark stores and higher average order values or AOVs, which improves the unit economics. Now, these are two very different beasts with very different cost structures, growth levers, and capital needs. It is very likely that at some point both Zomato and Swiggy will look into unlocking value by separating these businesses out. Now let's look at the numbers, and this is where things get interesting. On the surface, Zomato has turned marginally profitable while Swiggy remains slightly in the red. But given the capital intensive nature of this sector and the stage of growth, that is not the key takeaway. The real story lies in two metrics. The first is net order value per user per month in quick commerce. For Swiggy, this number has shrunk by 17% over the last 2 quarters. That means the average customer is now spending less per month on Swiggy's Instamart basket. In contrast, Zomato's Blinkit has shown 8% average growth in NOV per user over the same period. And not just that, Zomato's NOV per user is already much higher at 2,200 rupees per month compared to Swiggy's 1,200 per month. So Zomato not only has higher order values, it is also growing while Swiggy is declining. That is a very strong signal of customer stickiness and purchasing power. The second number is even more telling. Delivery costs as percentage of gross order value or GOV. For Zomato, delivery costs as a percentage of GOV has been between 5% and 7% in Q1 25 and Q1 26. But for Swiggy, this number is much higher, 13% in both quarters. Now, delivery costs are the largest cost component in both businesses. You can't get this under control. Profitability becomes near impossible. So, this metric tells us that Zomato is operating far more efficiently as compared to Swiggy. In fact, you could argue that Zomato has already crossed the threshold into being a fundamentally sounder business, both in terms of customer economics and cost discipline. So, what about valuations? Now, let's be clear, both stocks are overheated. The recent run-up means that they are priced for perfection. Any slip-up, be it in margins, user growth or burn rate, and the stock can correct sharply. So this is not the time to buy. But remember that this is a category creation story, and such markets tend to be winner takes all. Once a company crosses a certain threshold of network effects, habit formation, and operational leverage, it is very difficult for others to catch up. So there are still threats. Zepto is a real challenger and the market is far from stable. But if current trends hold, then Zomato looks like it has cracked the model faster. As an investor, the takeaway is simple. Watch the cash burn, watch the efficiency numbers, and wait for better entry points. There will be dips, and that is when the real opportunity will show up. For now, though, in the battle of Swiggy versus Zomato, we may just be seeing the beginning of a winner emerging.